Hey everyone, I'm Trading Man Dan with the Chart Guys, trader and technical analyst. We're going to check in on the markets with headlines this past week. DeepSeek, Trump tariffs, where do we stand in the market overall? Let's get to the charts as they're more clear than the words in the headlines.
All right, so I'm in travel mode. I'm on a small screen, so if I lean in throughout the video, that's what I'm doing. But we're checking in, and I want to talk about headlines first, then we'll get to price action. So in this environment, we've had a Trump presidency before. We know that his tweets significantly impact things in the short term in terms of volatility. But I cannot stress enough sticking with the most likely scenarios, because in this most recent example, that is what is taking place still. So we had two major news events. To start the week, we had DeepSeek AI, big sell-off on semiconductors, big bounces because a lot of things dumped with semiconductors like Meta and Amazon and things like that. And bulls bought those dips aggressively. And we had some nice bounces in the NVDA and semiconductors, but overall they are still having a bearish lean and a bearish correlation ever since that headline. So we're going to consistently be getting DeepSeek headlines. Did they use a bunch of NVDA chips? Are they getting them, nefariously? And is that contributing to NVDA profits that, potentially will be cut off if the US government cracks down, blah, blah, blah. So that's one aspect. And then to end the week, we now have Trump with tariffs and, going to put 25% on Mexico and Canada, 10% on China. It's kind of like a little bit of a threat, or the deadline's coming, or there's more info coming out this weekend that we'll have to look at. But all that said, if you show me these charts, I tell you the most likely scenario is taking place. When we have significant volatility in both directions, this is ES, so S&P 500 futures, as soon as you V-shape and we double top at our all-time high resistance zone, and as soon as you drop that hard but form a higher low, you scout an equilibrium. So we dumped all Friday afternoon in response to tariffs, but I was more surprised that we were going up significantly Friday morning, and it was due to earnings and things like that the night before. But again, the daily lower high is the most likely scenario. So for the last few days, I'm scouting the daily lower high and waiting for it, knowing that equilibriums being the most common pattern in markets, when you see that kind of significant volatility in both directions, is the most likely scenario. And so here we have a chart where if you show me this chart and you say, is there massive news taking place? I would say, there's some extra volatility. I wouldn't be surprised if headlines are contributing, but no, there's nothing impacting this chart. This chart has not given us any new information from where we were a week and a half ago, on the bounce back up when we were trading in this range. So if we start this week bearish with a little bit of downside, we're going to have a tightening range. And the most important support to us is going to be the low of the DeepSeek reaction and then the low of consolidation. And of course, resistance, there's now a wall of resistance being built right under the all-time high. But the better bounce was in the S&P 500. Why? Because there's rotation going on. The financial sector has been on fire. The healthcare sector has followed through with its bounce. And so semiconductors have been holding back the NASDAQ. And you can see the NASDAQ bounces aren't quite as strong. The bounce here did not get as close to the all-time high, and we dropped harder towards support. So where the NASDAQ stands, it is still our base of support that has been holding. And the FOMC reaction, pretty much a non-event at this point. Again, we're working our way through a lot of the major earnings. We're going to be coming towards the end of earnings season after this next week. But again, all we care about is this support zone as the most important. Do we confirm this lower high from Friday to start this coming week? And if we do, we look for a daily higher low, and we look to tighten up the majority of the week and probably a break at the end of the week. And if not, then first thing next week. But again, nothing about this price action is surprising. It's just a bit extra volatile. And that has been the case ever since the FOMC reaction mid-December. Volatility has picked up a bit in the markets overall. So obviously the direction that these tightening ranges break are going to have significant short-term implications, and the burden's on bears. Why is the burden on bears? Because we're in long-term prolonged uptrends. We have a base of support that has been holding, and bears have to prove to us that the market environment is shifting. Where I stand, I've still got hedges on because we haven't broken all-time highs, and I've maneuvered enough where those hedges are risk-free in the sense that if we get a new all-time high, I stop out and it's a break-even trade or tiny loss, and then the rest of my IRA benefits. So that's my ideal way of positioning protection but was only able to get risk-free because we see significant drops from resistance and you take a little profit. I sold a third of my SQQQ on the big gap down minus 4% morning on the S&P 5, or I should say on the NASDAQ. And that keeps you nice and comfy. So I'm going to have a short-term bear lean for the daily lower high to start this week, and then I'm going to watch for a higher low, and then we're going to look for a break from there. Semiconductors, decent bounce, 50% retracement or so, but it's all about this support zone, which has been the support zone for the last 4 months. And so again, daily lower high is the most likely scenario. Let's zoom in. We don't have an hourly downtrend. We just dropped straight. So we will have to see the bears confirm an hourly downtrend after the next bounce. Then we'll zoom out. We'll say the daily lower high has been set. And then we'll look back down at our support zone. And there's a possible scenario here where we have NVDA weaker. And again, these NVDA bounces have been really nice. It's been a nice range where, if you buy in the 1-teens and sell in the 120s, there's some nice flips there. I only did it once, but it was a solid, worthwhile trade from, I got a really good entry right around 117 and sell again into the mid 120s on the way up, but back down towards support now. And again, just visualizing how could this play out? Okay, well, if we get a bear break of the 116 low, but if SMH holds support, we would anticipate that, yes, NVDA can break support because of its relative weakness, but if SMH holds this level, then NVDA bears aren't going to get very far, and we'll then watch for the possibility that it's a falling wedge shaping up. So I'm going to be keeping an eye out for bear breaks with no follow-through to potentially scout some longs. After 113, we don't have a ton of support nearby. It's essentially 113.21, and then I'm looking down at almost 100 psychological. So the 1-teens are definitely important. And again, obviously the resistance zone, previous support, now acting as resistance in the upper 120s. But the relative weakness in NVDA remains. Tesla. So Tesla volatility is coming. How do we know? Because it's a constricting range. And we know that the constricting range is going to break sometime within the next 2 weeks. And probably 2 weeks. And so that tells us, I haven't traded Tesla in any meaningful way in the last month. And again, it's just, what's the trading opportunity of this 7-week window versus this 7-week window? There is more than twice. There's 2 to 3 times the trading opportunity here versus here. And so I cannot stress enough, this is going to be the point I'm driving home in February, is anticipating equilibriums and tightening ranges can very significantly help you know when to be trading aggressively and when to pump the brakes and stop trading and patiently wait for tightening ranges to break. And I'll talk about that in the quantum names here in just a moment, but it's the inverse. So while Tesla was doing this, quantum names were through the roof volatile, and I was trading them every single day. And now I haven't traded quantum names in over a week as they're constricting, and I know that my Tesla trading activity is going to pick up when this range breaks because the volatility and volume will return. And so at this point, the burden's on bears, and the simple statement is bulls have complete control of 373 as support. Why? Because we just had a big leg up to all-time highs, and this is now the scales of supply and demand balancing out and trying to find fair value in new price discovery range. And so if it's, hanging up near the highs and just chopping around sideways, that's a good thing for the bulls in the sense that, the market is accepting now the prices at 400 when previously we were chopping around and figuring out prices in the, 250, 260 range. So if we do break support, it's a weekly downtrend confirming, and we will zoom out and look for a monthly higher low with a lot of space for it to form. But otherwise, you can make the argument that's a 2-week bull flag if you want to put on that time frame. And what I'd like to see, having no position, is a daily lower high compared to 440, and then come down and ideally hold 384 initially and then get really tight. And oftentimes you'll see, this daily range is going to break first. And then once it does, we'll zoom out and see if there's follow through to break the weekly range as well. But get ready for volatility in Tesla within the next couple weeks. The financial sector has been on absolute fire on its earnings reaction. So V-shape back to all-time highs after 5-6 weeks of consolidation, and just straight up, like 10% plus straight up. Every single day but one was a higher low from the previous day. So we're on the verge of breaking 51.43. And if we do, daily consolidation is back underway. We'll watch the response to hourly oversold conditions. We can see a little weakness after hours Friday as well. So hourly oversold, if that marks a daily high or low, we know the bulls keep complete control. But we also know we didn't establish support on the way up. And very often you will see the stair-step moves, whether it's up or down, the retracement sizes are more significant because levels are not being established. And we'll look at the energy sector in a little bit here, and it's a perfect example. So you can have monster bounces or big-time dumps, but the retracement can very often be more significant. And that's why as a trader that has an edge playing oversold bounces, I love when things collapse and get, very extended, because if I get the bounce timing right, it's generally pretty V-shape and there's a lot of reward behind that. So daily consolidation, we'll scout a daily high or low, anything above 50.21 if it begins, and we'll watch the response to hourly oversold. The healthcare sector had another solid leg up this week. And again, at this point, we've been going up for the last 5-6 weeks. We have space for a weekly high or low to be the result of next consolidation. The bulls do still need to confirm a weekly uptrend at this point. But again, while semiconductors and the NASDAQ haven't been doing a lot the last few weeks, they've been more sideways. We have the healthcare sector, which was a lead bear, turning into a lead bull the last 2 weeks. And again, it's just that rotation game that is keeping the bulls in control for now at this point. So daily uptrend here will remain our guide. Short-term support, 145.30. If that breaks, we'll look for the weekly consolidation. And again, you could put on, the 2-day time frame, condense it down a bit, call this an inverse head and shoulders attempt, and we'll see if we form a right shoulder and can confirm it. So quantum names, as I mentioned, look at this weekly bar for RGTI, and it's still a very wide range. That's almost a 20% range on the week, but compare it to the prior 7 weeks of trading. It's the least amount of opportunity within a week of trading that we've seen in 7 weeks. So I should have my trading be the least amount of trading on this name in the last 7 weeks. I want that to match. Again, the range is the pie. The bigger the range, the bigger the pie for me to get my piece of the action with locking in some profit. If the pie is small, there is less opportunity. There's less of a pie for me to get my slice. And again, knowing I'm not going to be nailing tops and bottoms, bigger the pie, the more meat in the middle. Now we're crossing analogies, but you get the point. So we're still watching quantum names for tightening weekly ranges, as we anticipated was the most likely scenario. And I knew in advance, I was saying 2 weeks ago, I'm going to be trading quantum names way less in February, because the most likely scenario after this much volatility in both directions is that you tighten up. And so I pump the brakes, because if I were to keep trading the quantum names with the intensity, with the frequency that I traded them the past 7 weeks, I will give back a lot of my profits. It is not the same market environment that I was just trading in. I have to recognize the change in the market environment and adjust my trading accordingly. That's the epitome of being a professional trader, is just shifting around focus based on that. Okay, so if the weekly inside bar breaks bear, it's a weekly lower high, and we then scout a higher low compared to 595. RGTI is one of the stronger names out there. It has not set the weekly lower high yet. If you look at QBTS, it set the weekly lower high. No follow through. We're also in a scenario where, if this little dinky tightening range breaks bull, I would zoom out to the 2-week time frame and look for a tightening range. Again, we can just so easily trade within this tight of a range for a very significant period of time. I should say this wide of a range. We have IONQ still holding well for the bulls. High, low, lower high. So we're scouting a weekly high or low. We did see some bearish response to the market on Friday afternoon. Can bears confirm the daily downtrend to set that weekly lower high more convincingly? But again, I know I'm going to be trading a lot less the next few weeks, and then I'm going to be right back to trading quantum more actively when these weekly tightening ranges break, probably in March. And QUBT is the weakest of the quantum names that I watch. It's still a weekly stair step at this point. Lower high the last few weeks, but again, just tightening up. Lowest range, smallest range in a couple of months for the sector. Dollar trying to form a weekly higher low off EMA 12 support. Bulls need to regain a daily uptrend. Meh, I guess you could say we already did. So we clearly have to see weekly EMA 12 loss for the first time in months if anything's going to shift more significantly. But gold bulls are happy. Even though the dollar had a solid week, gold hit new all-time highs. We knew this was a monthly bull flag with 0 red flags. Inside bar bull break on the monthly, new all-time highs. So gold bulls in complete control. We got a daily uptrend, a monthly uptrend, nice and clear. Silver, not quite as strong, but we were watching a 2-day falling wedge, and that has broken bull. I was watching it here. You could have drawn it there as well. Little back test. So we had a little back test and hold. Bigger picture now. We go to the weekly chart. And again, a potential inverse head and shoulders where if we do not break 32.33, we'll look for something like that to try and shape up. Overall, I still have a smaller position left on a long-term swing that I've been in for many, many months. I forget when I entered at this point, but for me, the criteria for keeping my runner, I took a little profit when this weekly lower high was the most likely scenario, but it's the monthly EMA 12. I will keep a position as long as monthly EMA 12 is support because that is what's been holding. And again, these monthly candles are now closed. And you've got some things like MSTR in the crypto world, multiple monthly inside bars. So again, just massive opportunity for this month, less opportunity in December, less opportunity in January as a trader. And again, back here, constricting, sideways range, lack of opportunity, 2 months of massive opportunity. That is all the market is doing is just breathing, inhaling and exhaling. And so we want to be catching these spikes in volatility when tightening ranges break. And multiple inside monthly bars are probably going to break here in February. Oil. So oil had a rejection from key $81 resistance, which is keeping us within a 2-month equilibrium. Again, if we can't get over, I guess here it's 80 on the spot. But if we can't get over that resistance level, it's possible we keep trading. Again, I'm just repeating myself, but a constricting range. We keep trading within it possibly for another few months. But when this breaks, this is the tightest, this is the longest term range that oil has been this tight, a year plus, in a significant period of time. Look back here. This was comparable, longer term, and look at the volatility that happens when the range breaks. Massive volatility, insignificant opportunity trading, choppy sideways, massive volatility, sideways chop, massive volatility. We are in the sideways chop, and we're going to get massive volatility mid-2025. It could break at any point, and there'll be headlines with it. So this is where you see headlines will lead to this tightening range breaking with follow through. Very often that happens. And so with that, the energy sector, so this is what I'm talking about with the retracement sizes being more significant when you don't establish levels on the way up and down. So a lot of important lessons in this video. Big picture. Anyways, straight drop, waterfall drop, V-shape, 75% plus, get that move back. Big drop because you didn't build support on the way up. And that's why the equilibrium becomes the most likely scenario with this kind of range. And so we're scouting a weekly higher low on XLE compared to 82.40. Again, the most opportunity trading, less but still plenty, anticipating less but still plenty. And then you get to a point in the equilibrium where you're, after a few pivots, it then stops being worthwhile trading and you wait for the tightening range to break. So we're scouting a weekly higher low on XLE. I still have a little bit of a runner position from getting a really good nailing of the bottom. My break even on the trade is well below those lows. So just going to let it play out. Might add back. I need a level where I can say that's either the weekly high or low or I'm wrong if I'm going to add back, because I'm not going to add back now and go off of this low down here that's too far away. It's bad risk reward. I need a level that's right nearby so my risk is small and the reward is much greater than that risk. Natural gas weekly consolidation underway. Part of the process of holding a long-term position is that you're going to be sitting through weekly consolidation, potentially monthly consolidation. And so, we had a weekly stair step for 7 weeks that broke, and we're now looking for a weekly higher low. Bulls definitely want to hold EMA 12 ideally, which is being tested, and this back tested previous resistance now support. But because of the size of this pullback, we also have space now for a weekly lower high. And so if bears can confirm a weekly downtrend, we're going to have to go back to the monthly. And the bulls are going to have to shape up a monthly trend change attempt if this is going to be a long-term bottom. So, going to let it play out. Again, just get nice and comfy. I don't give any attention to natural gas. It doesn't take up any of my mental capital. I've got a position from down here. I took some profits. I'm risk-free. And I just let it play out. We're either going to get to the 5s, and I'm going to look to take more profit, or I'm going to stop out break even. And in the meantime, I'm going to be trading everything else in the market because natural gas isn't my jam. And I'm just going to let the trade do its thing one way or the other. All right. So lots to summarize here, but the most likely scenario on charts do keep happening in the face of volatile tweeting and headlines and tariffs. It can magnify the moves. It definitely spikes short-term volatility and volume, but the most likely scenarios rule out and will continue to take place more often than not. Not every time, obviously, but that should be your default. And then everything else is just a little bit of an offshoot of that. So daily lower highs on watch for the futures. Then we scout the higher lows, and then we look for a break towards the end of this coming week or first thing the following week. I'm not going to summarize everything else. That's what AI is for if you really want it. But again, this was a good video. Oftentimes I just do the rundown of the here and the now price action, but this was a good video for bigger picture concepts about how we should be approaching trading, from a what should I be focusing on perspective. Newer traders very often struggle with so many things. Oh, there's opportunity over here. Do I go after this flashy object? It's all about identifying ranges that will constrict and tighten. And then the most likely scenarios with the higher lows and lower highs as they tighten up. And then waiting for those constricting ranges to break, knowing volatility and volume will return, and increasing your trading activity when that happens. As always, do good things. I hope you have a great weekend, and we'll see how this all shakes out.